Hi traders, it's Eddie here from TradeView. Welcome to episode 424 of Trading Talk. This is a special episode of Trading Talk. I wanted to do it because I've been speaking to some of the clients on the phone in relation to this year's Algo Trading Conference and the core model and the core framework that we're presenting. And the interesting thing is that I get the feeling that some people I'm speaking to that I don't think they understand what's going to be presented at the conference, because they seem to think that they've seen something like it before, or they're already building something like it, or they can get something like this anywhere, but that's simply just not the case. This year what we're going to be presenting at the conference is so far on another level, it's actually not funny. It's like, I think I'm a pretty good athlete and I think I can run quite fast, but I can't run a sub 10-second 100 meters like Usain Bolt, okay? To get to that level, it's a massive difference between running fast and the speed that they can do at the Olympics, okay? To get there, it's like your top 0.001 percenters of people that can get there. And I'm explaining that because at the conference this year, what the framework is it's like that 0.0001%. Okay, you will not be able to get there just by simply being good at maths, being able to code, having traded for 20 years, or any of those things. The only way to be able to build something or to have something like the framework that we're doing at this year's conference is to work at an institutional trading firm and basically build models for a living, which is what I've been doing since I've been here for the last 13 or 14 years. So I'm not saying that in a negative way, I'm saying that in a positive way, because when you come to the conference this year, this is what you're going to actually get access to, because it's our 10th conference this year and I really wanted to go all out and give the client something special. So again, I wanted to make the video and make this trading talk and this introduction to explain that when you come to the conference, you're going to get something like you haven't ever seen before. And I'm 100% confident that you will never, ever take this the right way. In your own life, your children's life, your grandchildren's life, and your great-great-grandchildren's life, you will never, ever be able to build something like this, okay? It's like you will never, like I will never be able to run in the Olympics, even though I think I'm quite fast or I'm quite good at sports. I'm just not at that level. And the amount of work that it takes to get from the level that I'm at to that elite level, it's really unbelievable. Okay, some parts of the framework, for example, probably took me 6 months to actually build in the past, but that's 6 months worth of building with an immense amount of knowledge that I had for years prior to that. So that's why I'm saying if you haven't had that experience, you're not going to be able to do it at that level. And that's why you should definitely come to this year's conference. All right, that said, in the video, you're going to see some aspects. There's actually 9 or 10 layers to the framework itself. You're going to see some aspects and hopefully get some type of an idea of what the framework is capable of. All right, and I hope that really inspires you to come to this year's conference. Start using the framework, and then next year what we're going to do with our clients, the people who've come to the conference, they're going to be able to start running other models within the framework. Okay, so when you come, you get the core framework, plus we're going to build up 10 models based on concepts from all the previous speakers that we've had. So it's by far and away the best thing that you're ever going to see in relation to trading in your life. That's my belief. Okay, because I've seen what everybody's been doing. I've seen what other people do out there. I've seen what our best clients do, and we've got some smart clients, okay? And I've seen what other smart people do who aren't our clients. And I haven't seen anybody since I've been here present anything or talk about any of the concepts that are at the level of what we're going to show at this year's conference. So I know this has been a long introduction. As you can tell, it is something I'm really passionate about because I put so much work into it. I really want to deliver something that's absolutely going to blow everybody's minds. And I am personally 100% confident that this is going to put you, I would say you will never see anything like this. I think people might start coming to this conclusion in maybe 10 or 20 years, okay? But you're going to be able to get access to it now and start running things in more of an institutional style way like we do here on the trading desk. So yeah, I've made the video. Really hope you enjoy this week's episode of Trading Talk. I'm actually going to put it out there for free. You don't have to buy this Trading Talk series to watch it, because I want everybody to get a bit of a glimpse of what they're going to get. And by the way, if you do watch the video and you still think that you can do it yourself or you can do something better, then I definitely encourage you to give me a call and try and explain why. But I really think maybe you should leave your ego at the door and have a look at what's available and put your ego aside like I've done myself in the past, and actually learn and move forward to the highest level you possibly can get to. So anyway, that's pretty much it from me. Hope you enjoy this episode of Trading Talk. Look forward to seeing you at the conference, and I'm very, very excited, as you can see, to present the framework and everything this year. Till next week, all the best with your trading.
Hi there, traders. It's Eddie from TradeView. Welcome to episode 424 of Trading Talk. We've got a really exciting episode for you today. I cannot wait to get started. So let's just get started. This presentation is provided for information purposes only. You shouldn't regard it as financial product advice. Any back tests are not an actual performance record. All right, the reason I'm excited about this trading talk is because we are going to demonstrate our core framework, or certainly parts of the core framework. Now, what's prompted me to do this is I've spoken to a number of clients on the phone, and I mean this in the nicest possible, politest way, but they just do not get it, okay? And what I mean by that is I think people think that the core framework and the 10 models that we're building up based on the previous speakers at this year's conference is just the average sort of stuff that you can buy online. And I'm doing my very best to explain that it is not, that you will not be able to buy anything like our core framework online. You will not be able to create anything like our core framework yourself. And I mean that in the nicest way. I'm saying that to our best clients, our best programmers, our best everything. The reason I say that is because I've been here for nearly 14 years, and I know how long it took me to put this together with all the knowledge, with access to all the information, with access to all the best techniques, skills, resources, developers, platform, everything out there. And I know how long it took and how difficult it was to uh, not only build it, but to actually understand the concept and to put many, many different concepts together in a way that ends up becoming actually fairly simple. So, what I'm saying is, I know how difficult it is, and I know that it will be impossible for anybody to get to this level by themselves. What I do think, though, is that everybody who comes to the conference will have the opportunity to understand it. That is a fact. We will show you exactly how we build it and how we do it. And I think that every single person who comes is capable of understanding once they're shown. But without being shown, I'm 100% confident that they will never, ever, in their own lifetimes or their children's lifetimes or their great grandchildren's lifetimes, be able to figure it out for themselves. It is just that hard. Okay. So what I'm saying is, I'm trying to explain to everybody the complexity and the level of sophistication that's involved in what we're presenting at this year's conference. That said, once you see it, I think you'll be able to understand it, reasonably easy, with watching probably the conference a couple of times, because there's a number of concepts in there that I'm certain you haven't thought of before. But I think everybody's capable of understanding once shown, but would not be able to do it by themselves. Okay, so I wanted to show you part of it today. So what we're going to do, the objective for this trading talk is to really show you essentially the core of the core framework, because there are multiple layers to the framework, and that's why I'm saying this is not your standard algo that you can buy online or even get from the trading talks or even get from the previous conferences, because The way I see it, most of the stuff that you can buy online, we can already see better stuff than that in the trading talks, okay? Because we just did a recent masterclass about high risk, high reward algos, and anything online that you're going to be interested in buying, probably because it gets some sort of high returns in backtesting or whatever they display on the website. Any of those type of models, they're all going to work in a similar type of way. There is no other way. They're going to involve some type of increasing trade size, some type of staying in the trades until you make profit, some kind of funky hedging that's going to lock in a bunch of losses and defer the losses till later on, something like that. They're all going to do something like that. Believe me, again, don't have to believe me if you don't want to believe me. I'm just telling you that's the way it is. Okay, there is no other way to do that. And those type of models, as I've said many times before, they can work, but what will happen is eventually they will blow up, and you're probably not going to know when that's going to occur. So, as a professional, that's not the type of model that I would ever trade. I probably said this as well, and I'm going a little bit off topic. If you've got a lot of money, you might be able to trade one of those types of models, but it's not going to get you that, 40, 50% return. It's going to get you that 1 or 2% return if you trade it responsibly, because the models can work, those risky ones, but they can get into some pretty big size. Therefore, you have to have, probably multiple six figures in your account. And if you have multiple six figures in your account and you run one of those algos, it's probably going to return you maybe 1 to 2% per year, something like that. All right, so I've gone a bit off topic, but there's not multiple layers in that. There's multiple rules and funky bits and pieces, but there's actually not multiple layers that come together in a sophisticated way. All right, so that's about the best you're going to get online, and the trading talks are already better than that. Some of them have some layers like multiple time frames and things like that, but again, they're nowhere near the level of sophistication of this year's conference framework and the models that are going to run inside it. So let me take a little bit of time and explain what some of those multiple layers are. All right, so basically layer one is the market data, just the raw inputs. All right, technically, it is a layer, but it's not necessarily a build. So first what we're doing is we're looking at all the different data that's going on, and all that data, I can tell you, has to do with what you can see on the chart. There's nothing coming into the core framework that's not available to anybody on the chart. There's no other funky, you know, bits and pieces. Anything that you can see on a standard chart is what the core framework uses. All right, so open, high, low, close, volume, time, any indicators that are available, even though it does use some indicators, but very sparingly. And they're not that complicated. All right, so that first layer is really information only. The information comes in, that's what we're looking at. There's no decisions, no structure, just the data that comes in. So layer two is really the structural engine, which is probably the core of the core framework, and that's sort of what we're going to have a look at today. So there's actually, you'll see there's I think there's 9 or 10 layers that we're able to define. So you'll see that this is really the tip of the iceberg, but I'm hoping I can explain it to you in a way where you can see that it can go a lot deeper. So you're going to be able to see what structurally occurred, right, based on the way that we've basically categorized that raw data that comes in. You're going to see some facts that have been published according to our rules. We'll show you this on the charts in a little bit. So for example, levels, targets, and events. So all those things are mathematically calculated based on that data that we get. So there's specific proprietary calculations that we do, which we're going to show you at the conference, as to how we get those levels, how we get those targets, and what those events actually are. We've named them in here, but we've not named them. I haven't named them what they actually are because I'm not going to give that away until you come to the conference. But you'll get the idea. All right. So these are objective calculations only at this level, the structural engine, if you want the core of the core. So there's objective calculations only. There's no trading at this level. We're not determining the bias, although I will sort of include the bias in to show you a little bit in one of the tests in a sec. There's no management, so we're not managing the trades at this stage, and we're not making any decisions on the portfolio. And for the purposes of this discussion, when we talk about portfolio, what we're talking about is really the portfolio of models running on a particular instrument. Okay, so we're going to run multiple models on one instrument within the framework. All right, and then what we're going to do is we're going to take the framework and we're going to run multiple models on a different instrument. So if you want, the framework sits above the instrument itself, okay, at this stage. And look, there are some things that go across different instruments, but the majority of it sits on one instrument. And then what you do is you run multiple instruments on your trading account. That's a whole nother kettle of fish, all right, that we'll show you at the conference. All right, layer three is the market state. So, what environment are these events occurring in? Is the market trending? Is it ranging? Is it expanding? Is there exhaustion or is it transitioning? Is the momentum shifting basically from one to the other? All right, so what we're able to do is we're able to take those things that we've identified and basically work out what state the whole market is in. That's probably some things that you're used to looking at or thinking about, all right, but probably not sure how to define them. So these have all been defined. Actually, as I'm presenting this, I realize what we've done is what I'm going to show you in a minute is actually probably a combination of layer 2 and layer 3. All right, so these are persistent states, they're not events. So we'll show some of the events on there, but then we're also going to show some of the states. So that trending state, lasts for a little while the events occur within that actual state. All right. Layer 4 is a sequence engine. So I think I'm probably introducing you to a whole bunch of concepts you still haven't ever thought of. Okay, I mean, I'm pretty confident that if you are watching this and you think you know about this stuff, I'm pretty confident you haven't executed it yourself, because remember, I've seen pretty much everything that all of our clients are building, and I'm telling you that you haven't come close to this. And I'm not trying to be negative, I'm just trying to explain the magnitude of scale of how much more sophisticated this framework is than what anybody is doing. And by the way, when I say I've seen all the things that our clients are doing, right, I've seen what our best clients are doing, okay? And I've also know that our best clients are as good, if not, I would probably say better than 99% of the other traders out there, because they're already understanding concepts that when people came to us, some time ago, that I would probably say were smart people, they didn't understand those concepts. And I know that our clients who are getting some really good results, they do understand those concepts. I'd probably say that our clients are probably some of the smarter traders out there, and they're still not doing this stuff. And again, I'm not trying to say it in a negative way. I'm just saying it's trying to get you excited, because you're going to really go from, like I keep saying, probably a level 5 to a level 98, right? It's that big a jump. It's not a level 5 to level 10. It's level 5 to level 98. All right, so anyway, the sequence engine, what it does is it looks at multiple events in a specific sequence. So if event A happens, if event B happens, and if event C happens in a particular order, then we're going to the models are going to do a particular thing, and they're going to adapt accordingly. That might mean switching on some of the models. That might mean closing out some of the trades on the models. That might mean trailing some of the models, and so on and so forth. All right, so we're constantly looking at what state is the market in, what events have occurred, and what sequence of those events occurred in. All right, layer 5 is the model engine. So that's really where we actually start running the model itself. So there's multiple layers before we even place a trade. Okay. So what will happen is the sequence will occur, and then the individual model will look for the trade entry. So if the conditions of the model occur after the sequence has occurred, then we'll look to place the trade. And depending on the state, different things, the model might manage that trade in different ways, but that's another engine or another function that we're going to talk about a bit later. This will happen across multiple time frames. So you can imagine you've got the core framework, and in that, let's say you've got breakout model, trending model, mean reversion model, and a scalping model, and more. Okay, let's say those 4 models. What's going to happen is the sequence will occur, and then we'll say, based on this sequence, we're going to start running this model, and based on the market state that we're in, we're going to run it in this particular type of way. And we're going to look for that entry on multiple time frames. Okay, so that core framework usually is going to sit on the higher time frame, like a daily, for example, and then it's going to look for the entries on the daily, but then also on the time frames below. So all the models are independent of each other. So you might have your scalping model, your breakout model, your trending model, your mean reversion model, and each model that gets switched on in inverted commas is going to produce its own entry, stop, target, and invalidation rules. All right, based on what's occurring in the market state, what events have occurred, and in what sequence those events have occurred. All right, so already I'm telling you, you're probably you're literally 5 layers deep into the model. All right, and I've never seen anyone build anything with anything like this already to this point. All right, so basically all the things models are going to run independently, and they're all going to have whatever they need at that time's entry. Obviously, they'll have an entry. They might have a stop, they might not have a stop, they might have different rules to close a trade, they might have a profit target, they might not have a target, they might get out by trailing. Depends on a number of factors, but that's all going to be built in there. All right, then layer 6. Layer 6 is a portfolio manager. So again, for the purposes of this, when we're talking about portfolio, we're talking about one particular instrument. So do we want to, so we get the signal for the trade, and then at the portfolio level, we say, do we actually want to take this trade? All right. Do we have other trades in better positions? So we don't want to take this one. Do we, based on what's already there, do we have too many trades already and we can't afford to get any more exposed, or we don't want to get any more exposed? Don't take the trade. Okay. So the framework is going to look at all those things going on across all the different models on that particular instrument, and then it's going to say, should we actually take this trade? It's going to decide, do we want to take it? Do we want to not take it? Now that we've got this particular signal, say that we've got a long signal somewhere, do we want to take that long signal, or based on where that long signal is, do we want to reduce some of the short trades that we have? Do we want to reduce some of the short trades and add the long? Do we just want to reduce the short trades? Do we want to leave the short trades as is and take the long? So there's a bunch of other decisions that are going to occur. All right. And again, as I'm explaining this, you have to understand that this particular layer itself is basically its own algorithm. So that in itself would probably that probably would have taken me 6 months to get that right, okay, over time. It's not throw a few rules in. It's a serious algorithm. So just this particular layer probably took 6 months in my building of this framework over the last 14 years to get that built and get it working correctly. And that's why I'm saying it's not an overnight process, okay? Because if you don't know that that's what you need and you don't know how to build it, you're very far off already, okay? Not to mention the other elements of the model. All right, so might delay the trade, might be able to take that trade later if we get a signal, or it might actually weight the trade differently. It might take it at an increased size or a decreased size depending on what's going on. All right, so that's level 6. That's one of my favorite layers, the actual portfolio manager. Layer 7, we'll call it the inventory manager. So what it does is it manages, in inverted commas, inventory, not trades. So you can come up with whatever names you want, but I think this is a good way to explain it. What I mean by that is we're looking at how many trades we have, what our overall position is for all the trades that we have on that particular instrument. Let's call it the Aussie dollar. And we're going to decide, we sort of explained this in the previous one a little bit, but do we want to take profit on some trades? Do we want to rotate some of the trades? Do we want to hedge some of the trades? Or do we want to reduce some of the trades, or so on and so forth? So when I say we manages inventory and not the specific trades, we don't care necessarily, or the model in some cases doesn't care which model the trade comes from. It cares about what's going to be the best overall position for the book of trades that we have on that particular instrument. All right. So I'm trying not to give too much stuff away here, but I mean, even still, you've actually, it's one thing to sort of understand a concept, and then the other thing is to, of course, actually go ahead and execute it, which I can tell you is, uh, well, I didn't find it that easy. And hey, I work here every day. All right, so layer 8 is the execution manager. So this function is basically, or this part of the core framework is going to actually place the order. It's going to modify the order, so it's going to decide, like I said before, based on which state, based on other trades that we have open, based on a bunch of other factors. How are we going to place that trade? What sort of, are we going to have a stop loss? Does it not need a stop loss? Does it need, what does it need? Does it, are we going to modify any existing orders? So on the bar, not just placing a trade, we get a signal. Based on that signal, do we place an order? Do we modify some of the existing trades? Do we trail some of the trades? Do we partially close some of the trades? And do we match off some of the trades and a bunch of other factors? Okay, so this is, I think I said the other one was one of my favorites, but this is actually one of my favorite bits. So what do we do? How do we manage all the trades that we've got on the book? So there's no, this has nothing to do with the actual, the specific, it's not to do with the specific trading model. When I say it's not strategic, I mean it is actually strategic, but uh, it doesn't look for the entries or any of that stuff. It looks at what we already have, and if the entry conditions occurs, it might place the order, but it also might modify some of the existing things that we already have. And then you got level 9, which is analytics. So the model actually feeds back on itself. All those different things that we just talked about become measurable. So the state becomes measurable. What state were we in when we took this trade? How do we manage this trade? What was the outcome of that trade? What was our net positioning of the trade? How far further against us did the market go when we took that trade? And we can work out, oh, it probably comes into the next level, but next layer, but we can work out statistically um, how to improve the model. So we can actually look at that. We can analyze that ourselves. We have some pretty cool analysis tools in the platform that we can use, but basically analyze the model. But what the actual analytics layer will do is it will record all those events, all right, and it will store all those values. And then in layer 10, the learning layer, what it will do is that will allow the model to adapt over time. So remember, we have a sequence of events that occur, and then we work out what was the outcome of that event. And then based on statistically what happened, like I said, how far against us did the trade go? Would it have been better to enter a little bit later? Okay. And so the actual model will start to adapt itself in real time, and we can start to work out what is the best way to manage all the trades. So technically, the model should start to get even better than it currently is, because it can feed back that information to itself. All right, so good luck finding a model that can do all that stuff online. It's like I'm saying, it's far more sophisticated than anything you've seen. And that's why I get so excited about this conference, because I really, really want to show people how it's done on an institutional trading desk. Because I'll say this again, you know, you uh, to get really good, consistent results in the markets, you actually need to be in that top percentile. You need to be very, very good, all right, to get really good, consistent results, which I know that's what everybody's looking for. So that's why I'm excited to be able to present it to people, because I know that there's nothing out there like this. All right, so you probably sat through 22 minutes of me talking about this PowerPoint presentation, which is not the most exciting thing in the world, but what I want to do is I want to show you now something that we've built, so I can give you a bit of a visual demonstration of what to expect. Now, like I said, we're not going to show any trades placed or anything like that. We're going to show you pretty much what is level 2, layer 2, and layer 3. There's a few of the layers sort of mixed in, so I can show something, and it's just something that we put together It's just for a demonstration. So we've put on MT4 so I can run the back test with the indicators and everything, and you can see it. And we're looking to try and build all these indicators actually into the charts. All right, so I'll bring up an MT4 platform. All right, so here we go. So again, what we're going to show you, because I didn't want to give too much away, I've modified this slightly. So I've modified some of the names of things that occurs. In actual fact, we don't need to print these on the charts. The model just knows what's occurred. All the information gets stored within the algo itself. So when you run it on our platform, and when we run it, I actually don't need the information there, but it's just I've made it so it's visual. Also, you're going to see a couple of things. So you're going to see how we, um, you're going to see some targets. Okay. It's actually cooler if you saw how the targets were calculated, which we do have, but I'm not going to show you that here. So the targets are going to appear in a particular way. And I think it does still look pretty cool. But if you actually to see, which we're going to show at the conference, how they're calculated, it's probably going to blow your mind. All right, it's actually very, very, very cool. All right, but I still think it serves its purpose here. Um, Give me 1 second, I'll set it up. All right, so I think this should be the right one here. What we're going to do, we're going to start it up and I'm going to try and explain it as we go. So I've got a couple of different examples for you. I've got two examples. One's on Aussie New Zealand. It's a really good example because you're going to see two different types of market conditions and understand how it works. And then the other one we're going to do, we'll do on an index, probably the S&P 500. I actually think it's probably even easier to get this working on an index. So if you can, run it really well on an FX pair that does multiple it doesn't have to go in a specific direction where the index usually has an upwards bias, then I think it's working pretty well. So yeah, I've done a lot of testing on different stuff, and I'll show you. So basically, what happens? We'll go bar by bar. You can just see here we had some of the targets set. So basically, this target you'll see as they come, pretty much bang on the target there. Okay, that didn't get drawn, by the way. After the price got up here, it would have got drawn probably on this bar here. Okay, but you'll see those as they come along. So the way it will work is with the targets that I'll explain it as we go. So we start off, we're already halfway through, but we have a signal that says no more new buying. So that's one of the, as a particular event has occurred, and that event has said don't buy anymore. It means you can still stay in some of the long trades that you're in, but it says don't buy anymore because we're not, our confidence level that it's going to continue for a long time is decreasing. Okay, so statistically, there's a lower probability of the market continuing a lot further. So we're saying no more new buying at this point. Still hang on to the ones you've got, and what you might have is um, I don't want to give too much away. I'll just explain how it works because, yeah, but remember some of those other layers, there's all sorts of other things you can do. You can do trailing and modifying and all that type of stuff. Okay, so that's going to occur at the same time based on some of these events. So we have a target set there. Once we hit that target, something else is going to occur, and it's just telling us that, okay, we're at the target. Doesn't mean that it can't go further. When you on FX pairs as well, it usually does go a little bit further. There's also, we do calculations on that to work out how much further it might go. So we're saying now that there's another event's occurred. So we're saying we didn't want to keep on buying because of a particular reason. We're at our target, which is, the price that we were looking at. And now the particular move that's occurred, that move's now ended. All right. So we're starting to get some reversal type signals. All right. These are your events occurring, and they're going to get put together in a certain type of sequence. All right. So we're now saying that the momentum is slowing. It's another event that's occurred. All right. So the probability of the markets reversing is starting to increase, and therefore, because it's starting to increase, the models that are running on the different time frames are going to adapt accordingly. I don't want to give too much away. All right. So like I said, the probability of reversing is increasing. It doesn't mean it's going to reverse, and that gets handled a certain way by the models. But like I said, we keep getting these signals that the momentum is slowing. We're still getting these signals that the momentum is slowing. So the probability it's going to reverse is increasing. Okay, so you see we've set a target there somewhere. Now that target was set a few bars ago. Okay, actually, the interesting thing, like I said, I've just made up this indicator so that I can demonstrate the process, just so that, because we don't actually use this particular indicator, or the calculations are already done. In order to draw it just the way I did it to get it going sort of quickly, I actually let the projection of the target occur a bit later. All right, so technically the model actually knows where that target is earlier. All right, so we're not going to sell anymore. No more selling. We're saying that the momentum is slowing, so we haven't hit the target. Momentum is slowing, and we've come to the end of the particular move based on certain criteria that we're looking at. We have those events defined. Technically, each one of those events could really be its own algo. That's what I'm saying. There's a lot of stuff involved. All right, so now that the momentum is slowing, we might start looking to take on some long trades. Momentum is still slowing. Doesn't mean it can't go down anymore. It just means that it's slowing. Remember I said we're looking to take on some more long trades around here. And then based on where we're at, the targets and all the other stuff, the models are going to get managed accordingly. Where the stops are, if there are any stops, which models trade, so on and so forth. So again, we've set another target there. We're not going to be buying any more. That's the end of the move. So we might not make it to the target. The momentum is slowing. We really might not make it to the target. But we do make it to that downside target. Like I said, it gets drawn a little bit late here. It would actually happen on this bar here, is where we get the information. All right, so again, we're at the target. The momentum is slowing. Doesn't mean it can't go down. There's our target. Doesn't mean we can't break the target. The move's ended. On this one, we actually didn't get that signal for the momentum slowing. So I'm going to run it through. So you can see there's a bunch of different events. And based on those events, we're able to set targets. And we're able to do a bunch of other stuff. Like I said, it actually looks cooler when if I drew it the proper way, but I mean it's still pretty cool with these targets. So I'll run a few more through. So as you can see, those targets, they're drawn quite a bit earlier. That target, remember, was drawn somewhere around here. Holds up pretty well. It's pretty uncanny how around the targets the momentum usually starts slowing. Watching, remember, like I said, around the targets, when we get around those targets, the momentum usually starts slowing. And that momentum slowing actually has nothing to do with the target, by the way. They're separate signals. Hey, look at that. That's pretty cool. All right, I'm going to show you something. So if we zoom out here, remember this was on the Aussie New Zealand. See how this has been? We started it up around here somewhere. This has all been a ranging type market, okay? Now, we always have people that ask how we're going to be able to define when the market starts trending. I'll show you that in the next run, but you can watch it yourself, okay? So you can watch how these change. By the way, the different color targets mean different things. Oh, look at that. So we projected that target a while ago. Pretty much bang on. I like it. Oh, look at that. Pretty much bang on that target. Oh, look, like I said, momentum slows around there. Oh, look at that. Pretty close to the target. Oh, look at that downside target. Ooh, pretty good. Would you look at that? See if you were going to try and get out of that move, where would you get out? Ooh, probably somewhere around that target. Maybe after we say no new buying. So remember, these are all mathematically calculated. They're not based on any standard indicators. This is proper institutional trading. Ooh, look at that. Pretty much bang on the target before it pulls back. So for example, I'm going to show you this in a second. This is all obviously uptrending market, but we're still getting these momentum slowing signals and everything like that. So these are going to, this signal in this type of market is going to make the models that run within the framework operate in a different type of way. It's not going to run the same as it runs in here. All right. And here you've got the momentum slowing. Momentum slowing. I think we've got, that's about it. All right, now what I'm going to do, I'm going to pause this for a sec. I'm going to show you with some different settings. All right, so we're going to run this again, and hopefully it should come up with something a little bit different. All right, so we're going to start this a little bit later, just before the market went from. So remember, it's been in a ranging type of scenario for some time. And we're going to see what happens, right? How the model can figure out when we start trending, because this is probably going to answer some of your questions. Or it might create even more questions, which is fantastic, and that's exactly why you need to come to the conference. So here we have a long bias, okay? See how this is printing up here? There's a certain calculation that's made that occur. That's one of the states, if you want to call it that. All right, so remember I said I've combined a few different things into this particular part of the core. And all the trades will occur based on what's happening here, and they will get managed in different ways depending on which sequence of event has occurred. All right, so we have a long bias here. Now, I think what will probably happen, see we've got this downside target here. See how that long bias has disappeared? So what's going to happen is we're going to start saying, okay, well, we're not confident that the market's going to continue to go up. So we're not going to run the models in the same way that we were. So we might start exiting some of the positions from the models that are holding some of the long trades. So in here, it might flick a little bit between both, but see, we don't get that long bias for very many bars. So we may have exited some of the trades. We might allow it to take some more trades with a long bias. Those trades might even take profit and get out and close, so we might not even have any trades. All right, but as of this, we're going to start winding down some of those long trades because the long bias is not there anymore. Now you're going to see it actually flicks to a short bias. Okay. All right, so it's flicked before we actually got that big move down. So we've talked about this before, being prepared for the next move. So the models probably would have, so you got the internal models, different, your breakout, your mean reversion, your, what did I say before, scalping, trend model, whatever it is, they would, when it's a short bias, they will not run the same way as they'll run in a long bias. They're probably going to be skewed more to the short side. Okay, so we'll start building up the short side positions, and in this particular case, worked out absolutely perfectly. All right, so by the time we get here to this target, we might have actually taken profit on all of the shorts, all right, from the different models. So we might actually have no trades open anymore, even though there's a short bias, okay, because the models will say, for example, once we get to a certain target, take profit on everything. So remember how we said here, no new selling, so we're not taking any more sells, because like I said, we've probably got out of all the sells because we've got a short bias. Probably the idea would have been to have built the book short, would have got out of all the sells, or trailed the stops down on the sells, or whatever we did. Might have got out the target, might have had some trailing stops. Depends on the actual model, how it works. But the idea would be that we'll probably be out of our shorts at some point here. Now, because the momentum is slowing and we've hit the target, for example, might be looking for some long trades, but because the bias is short, we're going to manage them in a different way to the way we manage them when a bias is long. So now we don't have any bias. We've probably got out of some of the long trades at that target, if not all of them. Short bias again, I think you guys get the idea. No bias. Models are going to run differently. Okay, now what you're going to see, well, there's no bias. Let's have a look. So at this point, it flicks to long. All right, now I'm going to zoom out because we had this question from a number of clients. Now, I really, 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 really want you to look at this, okay? I want to remember this. It's in around about 39 minutes. I'm going to tell people to watch this. Actually, no, I'm going to write that down because this is one of the key things that I think that people have no idea how to do, and this does it in a very, very cool way, okay? So you don't know how that long bias is calculated there, all right? But has it? Are we looking at a break of this level? No, we're not. Remember, these are all your ranges. Are we looking at a break of this level? No. Are we looking at a break of this level? No, because it just occurred, right? But we broke that level on this bar, but long bias just printed on this particular bar. Okay, so there's something else. There's mathematical calculation that is causing us to believe that we have a long bias and therefore adapt the models accordingly. So we're going to, for example, if it says long bias, this is going to answer the questions a lot of people have. They say, how do you know when to switch off your martingale models? Well, if we're trading the martingales, they're a more risky model, as we know. But at this point, they certainly wouldn't be running short, okay, because the bias is in the opposite direction. Okay, so this is some really, really important stuff here. Now, remember, we're not waiting for a break. Someone said this to me the other day, but Howie, but you don't know that the market's going up until you break this level. And I said, but that's not correct. I said, you don't know that the market's going up until you break that level. But based on our calculations, we're already deciding it's happening here. And even better than that, in my opinion, is the fact that we didn't have a direction in here. So we weren't long and we weren't short. Okay, and the models are going to get managed a particular way because we don't know what the bias is. I'm not going to give too much away, but what that means is once we get here, we won't have a lot of open short positions. Probably no open short positions, or very, very few. All right, they would have been stopped out well in here somewhere, and not with a massive stop loss. The actual model just would have been stopped out or taken profit if they actually were successful trades. All right, point being, we've now got a long bias. So watch this from here. All right, I'm going to just go sort of bar by bar-ish. So even though the momentum is slowing, even though we've hit the target, the long bias still remains, okay? So remember, we're looking at multiple layers. We're looking at the actual events that are occurring. We're looking at what sequence they're occurring in, and we're looking at what's actually, if you want to call it the trend, that's what the bias really is. All right, so we had one bar where it flicked off, another bar where it's flicked off, okay? But predominantly, have you seen anything here say short? No. Okay, remember it did say short before, so it does exist. All right, but it's not saying short. So people say, how do I know to not run the models in here? Well, here is your answer. Okay, it's telling us don't run them short. Okay, it's saying we think the market is going up based on a number of factors. based on all the calculations, all the different events that are occurring and the sequence that they're occurring in. And like I said, I've changed the names on these things, so that's not exactly what they are. All right, so at this point, okay, just want you to take note. 28th of May, we no longer have long bias, okay? And have a look at what's starting to happen now. Wow, would you look at that? Now you can go, let's come back on here. But it's switched off. So you can basically see that this long bias is switching on and off, and that's going to start to switch off very soon, most likely, as the market starts to reverse. If you go have a look at the Aussie New Zealand, as per today, we stopped at about a week out from today. If you have a look at, well, probably about 2 weeks, if you go have a look at the Aussie New Zealand today, this will have probably switched the long bias now off. Okay, so now, if you want, well, it might not tell you that the bias is short, but you might be able to start trading some of those short models. In fact, if you look at our live trading room, which we did last week, we actually started up a model short on the Aussie New Zealand, somewhere around about that $22.51 level. Okay, so that's basically how the bias works. So to answer everybody's questions, remember here, for the majority of this, all was long bias. A couple of times there was no bias, but it never came up short bias. It still hasn't come up short bias. So we're not going to be running models short against this. And that occurred from around about here somewhere. All right. So I hope that answers some of the questions. So how do we define a trending and a ranging market? Or how do we, well, we're not telling you how we define it, but how do we stop the models from doing that? And that's exactly how you do it. And in fact, people ask the question, how do I switch off my models at that point? That's actually not what you do as well either. So we're going to explain exactly how that works at the conference. That's why I still get excited about this, ladies and gentlemen, because it's so much more sophisticated than anything that you've ever seen. And I personally have worked so long to, it took me so long to work out, how to do this. Um, how to build an institutional type model. It took a lot of time, energy, building, testing, etc., even to get the model to where it's at for this year's conference. So far, myself and one of the guys here, James, has already put in over 1,000 hours, like well over 1,000 hours, to build it up and and get it really, really good for you guys and running, so that you don't have to think too much about it. You don't have to do too much of the setup yourself, but you can still understand the concepts. All right, I'm going to pause this for 1 second, and I'm going to run it on the index, and I'll show you how that works. All right, let's have a look at this on the S&P 500. I actually think this is an even better example. I think this model is even easier to run on the index, and I think the calculations work even better. So it works very, very well on FX, as you saw before, but I think it works even better on the index. So I'll show you. I'll show you how and why. All right, so here's your S&P 500. It's over the last few years. So here we've got our long bias that we talked about before. So remember, long bias doesn't mean that we're just taking long trades. It means that that in conjunction with the events that are occurring, the models are going to get managed in a particular way. All right, so there's multiple layers. So we all know, by the way, that the indices usually have an upward bias, right? And hence why, uh, so you should have your targets. Most of the targets there are going to be to the upside. We do have some downside targets as well. All right, have a look at this. So when's the best time to buy the S&P 500? Well, we're at our target. So if we were selling it, if the momentum was slowing and we were selling it, which we would have been, the model would have been selling it, okay, in a particular type of way. All right, so we'll manage it a different way based on all the other events that have occurred. Are we in a long bias? Do we have no bias? A bunch of other factors I'm not going to explain right now. The model would have been selling it. We would have stopped selling it around here somewhere. It doesn't mean that we haven't still got some sell trades on, but we would have stopped selling it. We've hit our target. So remember the target in conjunction with some momentum slowing, hitting the target is something in itself. The momentum slowing is probably going to say, we could start buying this up. And remember, this is only shown on the daily because it can only really show you one time frame at a time when we do the back testing, but things are going to be working on a lower time frame. So you don't have to wait for here to get the entry. You're going to have this signal occur on the daily, and then the lower time frames and models are going to say, "Ooh, we like this, right? We've hit our target to the downside. We've got the bar has opened above the low is below the target, and we've closed above the target. Ooh, that's a fairly bullish signal. So we're going to start entering probably long on the lower time frames. We might be in and out multiple times from here to here. But basically here, around there somewhere, we can probably start buying. All right, now we actually have a short bias. So if we had been buying it around here, okay, we probably won't be buying it anymore. We're probably going to start to get out of those buy trades if we're not already out of them. And that would have been a pretty good decision as we come down and we hit our target there. Would you look at that? It's not a bad target, is it? Wow, would you look at that? That's not a bad target either. All right, so remember, as we come down and hit this target, we don't have a bias. And we might not run them the same way as we'd run them long, but we don't think it's short anymore. And we've hit our target, and the momentum is slowing, and a bunch of other bits and pieces. So we might start buying the market up. Okay, now we do have a long bias again. Would you look at that? All these targets are going off the screen, I think, aren't they? So again, you can see for the index, it's picking the actual bias, the actual trend pretty well. So we're not confident that, the market's going up, as obviously you can see. We've set a target there. We set that target a while ago, didn't we? But would you look at that? Wow, that's pretty cool, isn't it? Hmm. And you can see the bias is long again. So no bias doesn't mean no trades. This means we're going to manage the trades in a different way to whether we had short or long. I think it was actually a pretty good example here. Got our long bias back again. Now we don't. Now we actually have a short bias. But remember, even somewhere here, we had no new selling. All right, so you might miss out on some of this here, but you're probably not going to get stuck in those short trades, and you're not going to be taking any shorts around here. And then when we get the momentum slowing here, probably a good time to look at reversing. All right, a long bias is back. I'll keep running it through for a little bit because I think we had good pullback somewhere this year. Where are we? Still 2025. So if you don't trade the index, maybe you want to think about trading the index. I think it's when you run in with the framework, you probably find it's a lot cleaner than running on your FX pairs. sitting around that target there, that upside target. We don't have any bias. So remember, actually, we didn't have any bias from some time ago. So what that means is we're not basically looking to stay very long. We're probably getting out of a lot of the longs at that point. We now have a short bias. In the indices, the short biases usually don't last for that long. Got our target there. Have a look at that. So that target was set a while ago. Look at that. That worked quite nicely, didn't it? Beautiful. See where the target is to the upside on this one. Let's have a look. Okay. Hasn't given us an upside target for this one. Okay, there we go. Where are we at? 25th of May. That was about a month ago. And that's about where we are now. All right, sitting around that target. So still got a long bias on the S&P 500. So the trades are still going to operate in a particular type of way till that disappears, and then we'll probably start getting out of some more of the long trades, okay, and then start to maybe or basically start to take some of the risk off. All right, anyway, I'm not going to talk too much about it because you've got to come to the conference so that you can see exactly how it's done. But to me, like I said, I still get excited. I get excited every time I see this stuff. I don't specifically use these indicators because it's all just calculated. And there's an actual better way to show you, but I think that might give too much away, so I don't want to do that. But I think that makes it look even cooler. But even still, I think it looks pretty cool. I think there's a few layers there, as you can see. You're starting to see, like I said, there's 10 layers to the conference if you count the data as the first layer. If you don't count the data, there's 9. But there's 10 layers, and you've sort of seen across some bits of a few of the layers without the trades. And the trades are going to happen on the daily time frame, but also on the lower time frames based on the events that are occurring. And that, by the way, isn't all the events. That's some of the main ones that have occurred, and it depends on in which sequence. So I hope from watching this, my main purpose of doing a video was that you watch this video and you take my comments in a nice way, where I say I'm telling you, right? The reason I wanted to do it is because if you think that you already have something like this, or you've already seen something like this, or you think you're going to be able to get something like this somewhere else, I'm hopefully when you've watched this, you realize that you will not be able to get anything like this, and that this conference is going to, in my opinion, it is going to move the needle on what's available to traders forward by about 10 years. So the clients that come are going to put themselves miles, 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 miles ahead, and they're going to start building other models to work within the framework, okay, rather than continuing to try to do, what's already out there. Right, if you've tried what's already out there and it's not working, then you've probably hit the limit of what you're able to do. Okay, you need to go to the next level. So I hope that you're able to see that. If you still watch this and you think, that's nothing, I'm already better than that, I'm too cool for school, etc. My suggestion is leave your ego at the door and take a good hard look at yourself, because it's only going to be your money that you're losing. All right. So I'm not trying to be rude. I'm just telling you the absolute truth. Hope you can see that it is many, 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 many levels above, what is currently available, and it is so far ahead of anything that I've seen from any of our clients. And like I said, I've seen our clients, I've seen people who haven't worked with us, I've seen everything in 13 or 14 years I've been here, and nothing has even come close. Okay, not even close, as in maybe 2% of the way to this. That's not an exaggeration. Anyway, I'm going to stop waffling on. Hope you enjoyed the video. Really look forward to, for those of you who are coming to the conference, I know as many people are going to be excited. So those of you who are coming, I'm excited. It's going to be on the 5th of December. We're probably going to do it in the office here, which is going to be a little bit different, but I think very, very cool because you actually get to have that real trading environment. You get to see exactly how it's done. So this year is all about institutional trading. After this year, I'm not going to present this framework ever again. So if you don't come to this year's conference, you will not know how to do it. And then what I'm going to do is I'm going to work very closely with the people who did come, and I'm going to make sure they get some really, really good results that they deserve so that they can go out there and tell everybody how great it is. All right. Well, I'm 100% confident that if you run this properly, it's going to put you on another level altogether. That's pretty much it from me. Hope you enjoyed this trading talk. And until next week, all the best with your trading. Come and see me at this year's conference. Let's go to the next level. Bye for now.